Global markets are mixed, weighing up a trade truce between China and the US against doubts the Fed can cut again this year. The ECB and the BOJ hold rates, and New Zealand business confidence lifts. That's coming up in our 5 Things in 5 Minutes on Friday, October the 31st. And then, in our deep dive interview, ANZ international economist Tom Kenny analyses Fed Chair Jerome Powell's comments on the risks around a December rate cut.
Powell indicated that this big division suggested that a December cut was not a foregone conclusion.
But first, in 5 and 5 with ANZ, markets were cautious overnight, weighing up news of a truce in the tit-for-tat tariffs and trade restrictions between China and the US against some uncertainty about future Fed rate cuts. Here's ANZ Head of Asia Research, Koon Goh, on the details of the deal done yesterday between Presidents Xi Jinping and Donald Trump.
This resulted in the US halving the fentanyl tariff from 20% to 10%, and there was an agreement generally on rare earths. So overall, it was largely what was expected. However, the market felt a little bit shortchanged because I think the market was anticipating perhaps more of a breakthrough. And as a result, we did see the yuan weaken slightly and Chinese equity markets paring back some of their gains. Now, we're still waiting for more details in terms of whether or not there's going to be a greater deal to be signed. President Trump did indicate that some kind of a deal could be finished off in the near term.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was down 0.5% and the Nasdaq was down 1%, with investors more focused on mixed tech earnings than the detail from the Fed or those trade talks. The yield on the US 10-year Treasury rose 4.1 basis points to 4.094%. That's quite a move. The yield on the 2-year Treasury rose 2.4 basis points to 3.61%. West Texas oil futures were up 0.2% at $60.61 US a barrel. Gold was up 0.3% to $4,012 US an ounce. The US dollar index was up 0.4% with those interest rates. The Aussie dollar down 0.4% to 65.51 US cents. And the Kiwi fell the same percentage to 57.41 US cents. Number 2. Koon says an important outcome from both sides was the reaching of some common ground and understanding.
Hopefully, we won't see any further escalation and both sides continue to work to resolve any differences in an amicable manner rather than threatening with tariffs or other types of escalation. So if we see a further stabilization and things being worked out behind closed doors rather than in public, I think then that will reduce the amount of volatility in markets. And I think the further reduction in tariffs and other steps to improve the relationship should provide a much better overall environment for markets and also, more importantly, for businesses.
Number 3. Overnight, the European Central Bank held its key deposit rate at 2.0%, and President Christine Lagarde was non-committal about future rates. But ANZ economist Henry Russell in London thinks the ECB may need to cut again later this year.
The euro area's export sector remains under pressure from tariff disruption. Credit dynamics are weak. The anticipated fiscal support has yet to materialise, and household savings are still rising and are very elevated. Overall, this points to a fragile growth climate. The ECB's own forecast for inflation back in September showed inflation falling below 2% next year, and without a sustained improvement in growth, the risks of a persistent undershoot are growing, and we remain of the view that the ECB will need to adjust its policy rate lower.
Number 4. The Bank of Japan held rates as expected yesterday at 0.5%, with 2 dissenters favouring a hike. ANZ international economist Tom Kenny says Governor Ueda indicated a cautious approach would be followed.
He cited that the central bank wanted to have some time to look at further developments in wages growth, and they also want to take some time out to have a look what the impact of tariffs are on the global economy and also the domestic economy. Their expectation is that the Japanese economy will take a bit of a dent from that higher tariffs, and that shall flow on to sort of a slowing in the inflation trajectory there. So they're kind of suggesting that inflation is going to be soft in the short term. And I think that suggests that, any thoughts of a December hike, which was sort of at over 50%, I think, leading into this meeting, is now dropped to around 40% there.
Number 5. New Zealand business confidence jumped 8 points to 58 in October, according to ANZ's Business Outlook survey. ANZ's New Zealand chief economist Sharon Zollner says the bump was led by a sector hit hard by the mid-year economic slump.
What was interesting in the data this month was that the retail sector improved more perhaps than others. So that does suggest that monetary policy is starting to work. Now, of course, the retail sector has been one of the most pessimistic sectors for some time. So in that regard, it must be remembered that the bar for improvement is low. However, it is encouraging that when you ask the retail sector about their activity in the last few months, it has been trending higher, and that corroborates what we're seeing in our ANZ card spending data as well.
Sharon Zollner there. Now, in our deep dive interview, ANZ international economist Tom Kenny talked to my colleague Alex Tarrant about the Fed's rate cut this week and growing market worries that a December cut isn't a sure thing.
There was two dissents, and of course, I think the first one from Moran, or the dovish dissent, was largely factored in by the market. I guess the hawkish dissent from Schmidt, Kansas City Fed president there, who preferred to leave rates on hold there, came as a bit of a surprise to some, but leading into that, we thought that was a potential possibility. I guess the market seemed to focus a lot on comments made by Powell saying that there's deep divisions within the Fed on the outlook for the December meeting, but I'm not sure how much that outlook is too different from September when they redid the Fed dot plot. We saw that the majority there, or the median expectation, was for 50 basis points more of cuts, whereas there was quite a substantial number expecting no more cuts in 2025 there. So Powell indicated that this deep division suggested that a December cut was not a foregone conclusion, but he did go on to say their policy approach is not on a preset course, it's meeting to meeting, and I just think if the data are there to support a further cut, then that's what the Fed will do. I think he placed a bit of emphasis on momentum of the economy, suggests that, the labour market is continuing to slow and the downside risks to that labour market have intensified in recent months, whereas the outlook for inflation, which he categorised ex-tariffs as being close to target, the upside risk to inflation, even though it might go up a little bit because of tariffs, is the risks there are mitigated quite substantially, he said. So, I guess going forward, there will be data-driven.
There's this perception that the Fed is partially flying blind given the lack of data or some data out from the US government. Did that show through at all, and what data is important to have out before that December decision?
Yeah, I guess that is, he did raise that issue. He said, it could be he said a case for caution at the December meeting. He said a couple of factors there. Well, one was that the policy rate is approaching neutral, which is kind of the destination for this normalisation path. And the other thing is that he said that a lack of top-tier data may fog any assessment of the actual and expected activity, and that this may be, in those circumstances, it might be smart to slow down the pace of easing. He sort of made the analogy to driving a car in fog that you'd slow down your driving so you could proceed with caution there. So in terms of the data outlook, in the absence of this top-tier government data, he pointed to quite a lot of data sets, ADP, Indeed.com on the labour market size, and he also emphasised the importance of the beige book. So he said there's enough of data around there for them to make a decision. It would be nice to have the top-tier data, but he doesn't think, if there was a meaningful shift in the economy, he said that, they would be able to pick that sort of thing up. It's only on the nuances that, that they would need that top-tier data.
Now, the Fed also announced the end to quantitative tightening. Was that expected, and will the path to end QT be as the market has expected it to be?
Yeah, well, I guess it's come up a little bit quickly. Powell mentioned in a speech a couple of weeks back that Fed was considering ending its QT in the next couple of months. So there was an expectation that there would be an announcement, but there wasn't sort of any clarity on the timing. So the timing might have been a little bit of a surprise. But given that the size of the balance sheet is we're starting to see the bank reserves shrink, and that's sort of squeezing liquidity in some of the funding markets and putting upward pressure on short-term policy rates there, that this QT is definitely coming to an end there. And in terms of going forward, the Fed expects to hold its balance sheet more or less at the same size, but it will continue to run off its MBS securities holdings over time as they come up for maturation. And as they mature, they will be reinvested into Treasury securities, and the focus there would be to invest in Treasury bills so that their portfolio of Treasury holdings matches more what's outstanding.
Tom Kenny there talking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, October the 31st. Catch you next week with further market reaction and detail on those US-China trade developments. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.